and welcome everyone. I'm Dean LaPierre and this is The Quantamentalist, the podcast that explores the risk management aspect of finance from the perspective of a self-directed investor and would-be trader. We've got a great episode for you today, so let's get started. Dean LaPierre is the co-founder and chief investment officer of Trading Edge Capital Management. All opinions expressed by podcast participants are solely their own opinion and not that of Trading Edge Capital. This podcast is for informational and educational purposes only and should not be relied upon as a basis for investment decisions. Good morning, tech traders. This is Dean LaPierre from Trading Edge Capital. Today is the 10th of February, 2023, and I've got an interesting trade set up here for you. Today I'm looking at CSCO. CSCO is a share that I've owned for some time, so I do keep an eye on it in my universe of trading. And as you can see by my graph, I'm fairly active in trading around CSCO, and looks like I've traded it fairly successfully over the past year. The thing that caught my eye on CSCO today was a couple of things. First of all, I like to keep an eye on the implied volatility in the market. We got a little tick up here in terms of IV rank, which is the first filter that I look at to see where the volatility is. The historic volatility is up high, and the implied volatility has now just crossed into a zone that has made the potential of maybe selling some premium around CSCO interesting. Now, there's a reason for that, and that reason is here. We have earnings coming out on the 15th of February, so just a couple days from now. That is clearly why the volatility is going up. And you can see in the past, whenever we've approached earnings in the past, you will see the volatility tick up, and then as the earnings are announced on the days, you see the volatility crush that just comes out of the shares after the announcement. So it's actually a very typical rise in volatility. If you are going to do a trade, particularly a premium sale trade, a short option trade, you've got to know that there's risk coming out with earnings. There always is, but the good and the bad with that is that you can play for a volatility crush. It looks like you get a pretty consistent volatility crush out of here if you're willing to take the risk of price movement after the earnings announcement. So this caught my eye. You can see we've got a couple of things on the chart that look interesting to me. First of all is this right here. I'm not a technician, but this is called a golden cross. When the 50-day simple moving average crosses over the 200-day in a bullish fashion, that's usually a bullish indicator for the shares. But we don't count on that. It's just the reason that's interesting to me is that other people out there who are technicians might see that as a buying opportunity, and we might be able to latch on to that movement or that positive feeling around CSCO. So we've had that happen. My cost basis is down here around $39 a share. It's currently trading at $46 a share. So I've got some decent equity in the position as well. It is a dividend-paying stock, so that's always a good thing to be paid for the ownership that you have. It is fairly volatile. The shares have moved around a bit. We've got a one-year high of as high as 57, and we've got a one-year low around 38. So there's a fair good amount of movement in the shares. And so this has caught my eye to see if we can make a trade out of this today. So let's just take a quick look at the fundamentals on the shares. You can see that the pundits out there seem to have a buy recommendation on CSCO. There's a positive feeling amongst the analysts. A quick look at the valuation here. The PE ratio of 17.6 is not fantastic. It's not necessarily a huge value stock, but for a tech industry share, trading at 17 times earnings is not unreasonable either. Let's see, what else can we tell you about this? The Trefis price according to Thinkorswim, shows a nice chart here that the shares are valued at around $50 a share. It's currently trading at a slight discount to that, so that's always good. Solid net cash balance on here. I don't think CSCO is going to be a candidate for going out of business anytime soon. So it's a good share. I do like owning it, and I wouldn't be terribly opposed to owning more. So let's put this onto our software package and see what we can find out and see if we can build a trade around this. So we're opening up Devos, which is our proprietary software package here at Trading Edge. I'm going to put in the ticker symbol, and let's go through what we can learn about CSCO. So I punched in CSCO. You can see the last trade was yesterday, traded at 46.73. The market cap, here are the fundamentals. We do have a decent return on equity, decent return on assets. Price to book about almost a little bit under 5 times book, and the PEG ratio is just at 2. And you know I like to see a PEG ratio below 2 before I start buying in a value situation. But overall, this looks pretty good. The Devos intrinsic value calculation has this share pretty much lining up with the Trefis price, our price that we put with a basic discounted cash flow model, as the share is worth about $51.40, and that all looks good. Here's that recent price history that was shown. We do have one red flag here, in that the price is currently trading below its 50-day moving average. However, it is trading above its 200-day moving average, and that's that golden cross that you see right there. And so we're kind of all jumbled together here in terms of price action. But again, we do like the intrinsic value of the shares. We do like the shares in general. Now, what's happening in the marketplace is we have the VIX term structure here is overall is looking in contango. We've had a little bit of a change overnight, and that is the 9-day VIX has gone above the 3-month VIX. So as people are starting to get a little nervous here, it hasn't turned the whole structure into backwardation, but we definitely have maybe a change out there. But at the moment, I'm going to call this VIX term structure to be in contango. Now, let's see. So this all looks pretty good. I do, as I say, I do own the shares. This is not a recommendation for you to own the shares, but I do like them. So let's see if we can put some sort of trade together that makes sense. So on the front month expiration, I'm going to be looking at the March 17 contracts, and we'll see if we can build something there. In Devos, you know, we start with, on the call side, and the put side, we start with one strike in the money, and then we grow from there. So on the call side, I know these shares trade, or these options trade, at $2.50 widths. So I'm going to start with the 45 and build up from there. 47.5, 50, 52.5, 55, and 57.5. And you can see here that as we get up around the 52.5 to 55, we do start getting a little less liquid here. The bid-ask spreads become a little wider. Now, still, we've got 4 penny wide market here. The 55s, we have a 2 penny wide market. Lots of open interest. And so I'm not going to worry about liquidity so much, understanding that when you get far out of the money, the spreads are widened. Now, we're also after hours here. We're before the market open overnight. So these bid-ask spreads tend to widen overnight. So that's all pretty well and good, and you can see we have the beginnings of our volatility smile here on the surface diagram. Let's populate the puts. Same thing, I'm going to start with a strike in the money and then drop down from there. So the 47s, 45s, 42.5s, 40, 37.5s, and 35s. Now let's make sure that I'm comparing the same delta range. On the calls, I'm comparing the deltas, call it the 2 delta to the 67 delta. And on the put range, I'm comparing the 2 delta to about the 53 delta. So those are similar ranges. With that, you can see the full volatility smile now here. As we get further out of the money, the volatility is going up. In fact, we have a little bit of put skew. We get about 7.7% put skew on here. Overall implied volatility that we're going to use for our calculation is going to be about 33 or 34, somewhere in that range. Now, the interesting part here is you can see where the front month vol, that 33 front month vol, compares to the historic vol. It is elevated, clearly elevated above the annual average, the annual historical average for CSCO, and well above recent times. So in there is where we think there may be some edge. This juiced up implied volatility in the front month being well in excess of historical vol for the shares is probably where there's a little bit of edge. It's tough to say for sure, but we're going to try to play for that edge. Also, I look here at the coefficient of variation on the historic vol, and generally it's behaved pretty well. Anything less than 20 on this indicator is going to tell me that there is lesser of a chance, at least historically, lesser of a chance that you're going to get super outsized moves that could disrupt your position. So that's all looking good. So from the standpoint of the stock, we've got the VIX currently trading at 21. That's up a little bit in recent times, but still very close to the historical average for VIX. The VVIX is under 100, which is also an indication that there's not a tremendous amount of fear out there, although that is growing as well. And the skew is at 120, which says that there is not a tremendous amount of out of the money put buying out there. So these are all bullish indicators for the market. We do have the term structure here showing backwardation, and that's that little dip here in the 3-month or the 9-day being elevated over the 3-month. So that little dip will cause this to say backwardation. But if you look at the full term structure, it still is in contango. So I think those are all still pretty positive. So these indicators are all pretty bullish. This is certainly a technical indicator that's pretty bullish. You've seen over here that the market is pretty bullish on CSCO. So if I'm going to do anything on this, I would be okay with it leaning a little bit positive delta, a little bit bullish. But as I said, we've got a little bit of change about here. This dip here in the term structure, and the fact that we do have a rising VIX and a rising VVIX is telling me that maybe some changes are about out there. So I'm not going to go hugely bullish on this. I'm going to look to limit the deltas a little bit. But this all looks pretty positive for a trade. So let's see what we can build. Let's go over to a trade builder. The first thing I do in the trade builder tab is I determine when I'd ideally like to be out of this position. So if I'm trading the March 17th contracts, I'm really looking to be out of here by March 3rd, 2 weeks ahead of time. So that would be the last day that I would want to be in this trade, and I'd close out my position if I didn't achieve my goals, or I would do something. I may adjust the position or something like that. So let's just see what sort of opportunities there are in. Let's just start with selling and options. I told you that my cost basis on this is somewhere around $40 a share. So if I were to simply look to match my cost basis or lower my cost basis, I'm going to see what selling a $40 put is going to look like. So if I select the $40 strike and look to sell one of those contracts, here's your put structure, your short put structure. This is actually looking pretty positive. I'm looking at over an 80% probability of profit. It does have a positive expectancy in it. The risk reward payout for this over a 2 standard deviation move looks very good. I'd be risking 53 to make 29 with an 82% pop. So that's actually a very good payout. The efficiency of the trade looks pretty good, with the exception being this one here, which is the expected return on capital. Now, I'm trading this in a cash secured account, so you can see the capital requirement is almost $4,000 to do that, which is the full value of purchasing the shares at $40. So it's not hugely capital efficient. The return on risk, however, over that 2 standard deviation move is actually very good. So it's not capital efficient, but it's got a good return on risk. And the suggested size of this is I could do maybe 10 times the size. I could do this is based on the size of the account that I'm trading. So I could do 9 or 10 times the size of this and still be within an effective size. But what I want to do is first see if I can get this a little bit more capital efficient. So if I look to make this a little bit more capital efficient, let's see what trading a hedge on the 37.5 will do. So I'll add this, turn this into a put spread, and you can see it does turn everything very positive in terms of still a very positive expectancy. It's got a 78% chance of making a profit. Payout ratio is still very good. Looks still very efficient, a 1.6% return on capital and a 9.4% return on risk over the 21 days that I'd be holding this position. Risk exposure is very much in line with a Kelly criterion. In fact, I could take almost 66 times the size on this and still be within those. So I've got plenty of room to move there. So obviously not a lot of credit here, $16 credit. So let's look at trading a bigger size on this. It's a tight width. It's a 2.5 width strikes. So let's see if I can take a 10 lot on this. What that will do. I still have very positive metrics. And here I'm now collecting $160 in credit. Everything looks pretty good, on that trade. I'm getting greens all the way across, both at the looking at it from an expiration standpoint, where I have a 93% probability of profit. Everything looks quite positive here for this trade. So the numbers line up really well. Now let's go back to the looking at this and see if I can juice this up a little bit more. As you can see, my cost basis is very low, and this particular forecast in here, you see the Garch models, and you can see the volume traded. These are the confidence bands or the the volume bands out here, and you can see that up around the 50, 52.5. That would be a very much an upside, a strong upside move up here. I do own the shares here, so if I got called away up here at 50 or 52.5, that would be nothing but pure profit. So let's see if I can add something to this structure. I'm going to add a couple of 50 calls, 50 strike calls here. So let me add, let's say, 2 of those up to the top. That takes my credit to almost $300 on the trade. What did it do, however, is that it brought down my expected return on capital. Now, the reason being is I haven't told Devos that I actually own these shares. So it thinks that these 2 short calls are actually being traded naked, when in fact they're not. So on a cash secured account, it would ask me to put up close to $10,000 for this. But in fact, that side, the call side, is covered. It's listed here in Devos as undefined risk structure, but it's not. I actually own the shares. So I am going to override this cost of capital and actually reflect the cost of capital here down on the put side, which is 2,200. So I'm going to override that cost of capital, and what you can see is I'm still not flashing. I'm flashing a little bit red in terms of my expected return on capital. Let's see if I can go a little further out of the money with this particular strike. I'll go to the 52.5. Now that seems to be a little bit better. So with this structure, I'd be collecting about $200 in premium. I like the way the trade is setting up for the 21 days that I expect to hold it. Very good probability of profit, good expectancy. Payout ratio targets are above. I'd be risking 359 to make about 180. And with a 73% probability of profit, that's a very good payout ratio. It's a very efficient trade. The Vega to Theta ratio I like to see under 3 at initiation, and that's 2.1. Delta to theta ratio, I like to see under 5. If I'm not very strong, opinionated about the whether the stock is going to move up or down, that's at 3.6. So it looks very efficient that way. Good return, or hits the target return on capital, hits the target return on risk, and the suggested size is there or thereabouts. I mean, I could certainly trade more of this if I want. My exposed risk is about 0.11% of my net lick. That's the Kelly criterion says for a trade of this, I could take up to 5.53% of my net liquidation value. So everything is lining up pretty well. Here is the Greek sensitivity profile, and you can see it's very well balanced. It's still a delta trade. I've got positive 28 deltas here. I had mentioned earlier that that's not a bad thing with looking at the way the stock is setting up. I don't mind being a little bit bullish on there. I'd be collecting almost $8 of daily theta here, and you can see that I am short Vega. So the Greeks align very well. Being short Vega means I'd be playing for that volatility crush that you tend to see here right after earnings. So I'd be playing for a little bit of that volatility crush coming up in the earnings. So I actually like the position. I like the Greeks. I like the ratios here. And as you can see, I actually did put this trade on yesterday. And here is what the trade looks like graphically. Here is that 10-lot short put spread down here by my cost basis. You can see it is outside of the volume banding. It's outside of the first standard deviation, and collecting a decent amount of premium. I also did go above here. I'm up here at the 52.5s with a couple of short calls. These short calls are covered by the shares that I own, so these aren't naked short calls. But again, outside of the volume banding and outside of the first standard deviation. So that's what the trade looks like. Graphically, I think it sets up very well. I like the trade. Certainly Devos likes the trade. It's giving me positive indicators all the way around. So I put that trade on. I thought you'd be interested in hearing more about it. If you have any questions, feel free to send me a chat or talk in the Discord channel. But that is the trade for today, which is a slightly bullish, fairly neutral trade coming into earnings on CSCO, a share that I do own, and wouldn't mind owning a little bit more if that came about. So I hope you found that helpful, and I wish you all the success in your own trading, and we will speak again soon.